Let's move on to banks. Of course, one of the talking points today is the fact that we'll watch out for how yields react to the second half borrowing calendar as it gets announced. Remember, the government announced a gross borrowing of about 14.1 lakh crores, out of which more than half is believed to be done by the end of September. And we'll know what the plan is for the second half today. Anyway, bond yields have been moving down in a pretty dramatic fashion. Yesterday, the 10-year yield was down to about a 32-month low. We're looking at levels of about 6.75 now in anticipation of more foreign flows coming into the market, as well as, of course, eventually the RBI also getting on the rate cut bandwagon. So in this environment, how do you look at financials and banks? Rahul Malani, DVP-Fundamental Research at Sharekhan by BNP Paribas is with us. Rahul, good to have you on. So let's start with that overarching question. We are probably entering a rate cut cycle. A, do you believe that? And if yes, then what's the best way to play it?
So good morning, Surabhi. So currently on the banking outlook, we believe that there is no earnings upgrade at least in the next 6 to 12 months. But rather than there is a earnings downgrade risk, marginal earning downgrade rate led by moderation in growth and a normalization of trade cycle as most of the asset quality, best of the asset quality is behind us, and margin will still be under pressure due to the elevated retail cost deposits, although wholesale deposits have rates have come down. And we are factoring in around about 25 basis points rate cut in December 2024 by RBI. So, and over a period of we are factoring around 75 to 100 basis points over this cycle. So basically, margins would definitely come down for banks, but over the cycle it will be passed on. So near term, there are no earnings upgrade trigger for the banks, but rather than there are certain marginal risks to the earnings estimates currently now.
Okay. Let's talk about, the larger banks first, because here also there's a fair amount of confusion. On one hand, I mean, there's a view that the best of the, credit quality is behind us and credit costs will start rising from here on. But we're in a downward rate cycle. So what's the call on large banks and which are the ones that you like the most?
So among the large banks, HDFC Bank continue to be in the course of balance sheet correction, and it will be a gradual state and it will take time. So among the large and while the one side Kotak Bank is involved in the improvement in its internal control systems and digital platforms. While we continue to prefer ICICI Bank because we believe that it is relatively well positioned among the large private banks as versus if you compare the growth versus the liquidity plus the deposit growth plus the asset qualities and the additional buffers on the balance sheet, we continue to believe that it is a sustainable story for at least over the medium term. For example, in the range, it will continue to deliver 15 to 16% growth irrespective of the sector. Industry growth, because it has been continuously, if you look at the deposit growth, it has continuously maintained the deposit growth in line with the loan growth, and which gives us a better visibility compared to the other peers.
Okay, all right. Hi, good morning and good to see you. What about the PSU segment? That was the sector that re-rated big time. PSU banks in particular, SBI, PNB. What's your view on these PSU banks now? Because many believe that bulk of the re-rating is done. Bulk of the good news is in the price. Would you concur?
So our view is that the outlook is still better and will continue to deliver at least 16 to 17% ROE. At least in the next 1 to 2 years, despite some moderation, but they will still able to report ROE in the range of around 1% range.
Okay. All right. Okay. All right. Thanks a lot, Rahul, for joining in and giving us your view. Bit of a technical snag out there. But